Hey friends, this is Ayan here and a warm welcome back to your own YouTube channel, The Delta Neutral. So in this short video, I'm going to show you a trade that I have taken in real a few days ago. It was a trade within the 15th November to 25th November window. This was the time frame within which the trade was taken with a very range bound view towards the market. My viewpoint was entirely range bound and I placed an iron condor and market entirely gone against my viewpoint. So the reason of sharing this video is this is going to be a very good example that how to adjust an iron condor and even how to adjust an iron fly at the same time. Okay, in this trade I have adjusted both of them simultaneously and I was able to manage with very minimal amount of losses and come out from this trade. Okay, I'll also show you that in case if I won't have made any kind of adjustments, what could have been the amount of losses that I could have made. Okay, but before starting this video, I'll show you a small mathematical explanation that why is adjustment necessary. Many traders would say you that in case if you are doing any delta neutral strategies, then you already know that what is the maximum amount of loss or what is the reward that you are going to get. Then why there is a need to adjust? No need to adjust, just sleep. But that is not the way it works. That is not the way it should be done. I'll explain you mathematically. Okay, just give me a minute. So let's just move to the Opstra option simulator platform here. Okay, so on my screen you can see I have opened the option simulator platform here. Okay, so let me go to the strategy builder page. Okay, well, it's taking a little bit of time, so let's move to the strategy builder page. So this is basically the strategy builder page, and in place of futures here we will select options. Okay, so just for the sake of example, I'll show you what the trade summary of an iron condors look like. Okay, so let's select any random expiry here. So it's 23rd of December. Let's select the 23rd December expiry and let's open the option chain here. So what we will do is we will sell a 10 delta put, we will sell a 20 delta put. Okay, we will buy a 10 delta or around 13 delta put to hedge it. Okay, well, so Opstra is pretty slow today. Sometimes it happens, there are technical glitches. Okay, it's taking longer than usual. Well, so now I will buy this put to hedge this position. Okay, the 10 delta put to hedge this position. Okay, so I hedge this using the 10 delta put. Okay, similarly at the downside I will sell a 20 delta call and buy a 10 delta put to hedge it. Okay, so where is a 20 delta call? The 17,600 call. Okay, fine. So this is the 20 delta call that I am going to sell, and 18,000 is a 10 delta call that I am going to buy in order to hedge my positions. Okay, so this one, so this one, so this one is the call that I am going to buy in order to hedge my position. Okay, so let's have a look at how our position would look like. Okay, in case if we place an iron condor like this, this is how our position would look like. This is how our payoff diagram would look like. So these are the break-even points. Okay, out of which if the market breaks through, then we are going to end up in losses. But in case if the market is going to stay within this range within the expiry date, then what is the maximum profit that we can achieve from this trade is around 5.3k, which is around 8.82% of the capital employed for this trade. Whereas the max loss that we can face in case it breaks through the break-even points is around 14,665, which is more or less 15k. Okay, so now what is the need of adjusting? What is the need of adjustment in delta neutral strategies? Okay, so here you can see that the probability of profit is almost around 63.07%. We can just consider it to be 65%. Okay, we can consider it to be 65% more or less. Okay, let's assume a round figure, and this profit and loss we can just assume them to be 5k and 15k respectively. Okay, so now let's do a simple calculation. Okay, if 100 ideal and simultaneous occurrences of this trade is done, okay, if 100 occurrences of this trade is done, then 65 out of 100 times this trade is going to win, and this trade is going to bring you 5000 rupees. Then what is the net profit that you are achieving from the 65 times out of 100 times? It's basically okay, so it's basically 65 into 5000, which is 3,25,000. But rest of the 35 times you are making a drawdown of 14,665, which is more or less 15k. So 35 times out of 100 times you are making a loss of 15,000 rupees. So what is the net loss that you are making there? It's around 5,025,000 rupees. So what is the net loss after the total 100 occurrences? Then you will end up in a net loss of 1,75,000 rupees. So in a long run, if you don't adjust, okay, if you don't adjust your monthly iron condors, or if you don't adjust your weekly iron condors, in the long run you are not going to be profitable. Okay, so this is a small mathematical explanation that why is adjustment compulsory and why is adjustment a must for every directionless traders. Okay, now I'll show you a proof. Okay, I'll share with you the trade that I have taken just a few days ago, and the purpose is the same, and the purpose is to make you understand that adjustment should be done, and to make you learn at the same time that what are the rules of adjustments and when we should initiate them. Okay, I'll try to keep this video pretty short and simple, and I'll only tell you the rules, and you need to only follow the simple rules, and you will feel the magic. You will be able to end up in profits or minimal losses whenever the market goes against your viewpoint. Okay, the market starts trending instead of a range bound movement. Okay, so let me show you the trade, and let me show you the price action based upon which I had taken the trade. So here you can see that I had marked a rectangular portion. So this was the time window. This was 15th of November, and this last green candle, it was 25th of November. So within this span of time, I had a thought that the market is going to be range bound for the coming 10 days. It is going to stay within a range of around 300 points on the upside and downside. And with this view, I placed an iron counter at that time, and you can see that my viewpoint was entirely proven wrong by the market. Okay, after 15th was a dodgy candle, and after 15th the low was broken, and there are consecutive bearish movements with great downside momentum. Okay, and this could have killed my iron counter position. This could have made a major drawdown from my account, from my trading account, for this 10 days. Okay, and I'll show you what could have been the amount of loss that I would have made in case if I won't made any kind of adjustments. Okay, let's just remove these things, and let's just make the position that I had make on 15 November in any virtual option simulator platform. Okay, so I am using Opstra to use the simulator on the past data. So here I will go to the option simulator, and well, already it's the 25 November expiry option selected over here, and it's 15 November 9:20 am. I usually prefer taking trades at the opening hours of the market, at the early hours of the market. This is because during the opening hours of the market, the volatility is usually higher, and due to this reason we get a greater credit, we get a greater prices of the options. Whenever we are selling options, then we are selling them at a greater price due to the volatility impact. Okay, so I usually prefer taking positions at morning. So what was the position that I had taken at that time? At that time I sold 20 delta call. I sold this 17,800 put. Okay, I sold this one. Okay, and I bought a 10 delta put here. I bought 17,600 put on that day. Okay, I bought this one, and on the call side as well, at that time I sold this 18,500 call, and in order to hedge that, at that time I bought this 18,700 call. Okay, So initially my position was like this, okay, and this were the break even points, around 17,750 to 18,550. See, I have marked these things on the charting window. Okay, I marked this thing on the chart. Okay, sorry. So I have marked these ranges on the chart, and from this point of time my viewpoint was that the market is going to be within this range. Okay, so this was my viewpoint, which was entirely proven wrong by the market, and that too within a span of only 4 to 5 days. You can see on the 5th day this range was broken with a large bearish candle. Okay, so there was also a pretty fast momentum in the market, not only a downward movement but also pretty fast momentum in the market. Okay, so now let's take, in case if we would have kept these positions unadjusted till 25th of November, what could have been the amount of loss that we could have made. Okay, so now let's shift it with 1 days. Okay, so it's 17th of November, you are in 62 rupees profit. Sorry, 17th of November you are in 182 rupees loss. It's 18th of November and you are in 337 loss. It's 22nd of November, you are in a net loss of around 2.5k. It's 23rd of November, again you are in a loss of 6,400 rupees, almost 6.5k. And this was 24th November, only 1 day left for the expiry. Right now we're in a loss of 5,000 rupees, and on the expiry day itself you are ending up with a loss of 7287. Okay, almost 7.5k, almost 7.5k is the amount of loss that you could have made from this trade, that I could have made from this trade, in case if I wouldn't have made any adjustment. Okay, so now let me show you how I adjusted my positions. What are my conditions that, well, now I should adjust my positions. What are the conditions that will trigger me to adjust my positions, and what are the techniques that I use to adjust my positions? So it's gonna be pretty interesting, because in the same trade I am going to adjust my iron condor, then convert it into an iron fly, and again even after converting it into an iron fly the market is again going downwards, so I'll also adjust my iron fly position. Okay, so I'll show you both of the things, how it's done in a pretty short span of time. So please don't skip any part of this video. In case if you are facing any problems, try to repeatedly watch it. Even after that, if you are facing any problems, please don't hesitate to put your questions in the comment section below. I'll try my best to answer all your questions and clear all your doubts. Okay, so now let's move back to the initiation of this trade, which means on 15th of November. And now I'll show you that in case I'd follow these rules of adjustments, then how I saved myself. Okay, so it's, well, so it's 15th of November and 9:30 again, and right now there is no PNL. Right now again we are in a stage where we have just initiated our trade, and now what we need to do is, let me tell you one thing, friends. Whenever you are going direction neutral in a market, it also means that you are going delta neutral in a market. Okay, so what is this delta, theta, gamma, vega? If you are not aware about this, I'll make a separate and much more interesting video on these topics, because by far these are the most important things in option trading, in derivatives trading. As of now, just make sure that you need to track the delta. Okay, nothing except that. You don't need to look at the charts, you don't need to read the news or nothing. You just need to have a look at this Greeks. As of now, you just need to have a look at this delta. Okay, so what is your total positional delta here? It's 4.13. so it's not a matter of concern. Only I'm so sorry, only be aware whenever this delta value touches 15. Okay, it doesn't matter whether it's minus 15 or plus 15. You have to just check whether the value, the absolute value of this delta crosses 15 or not. Okay, whenever it will cross 15, your adjustment rules need to get triggered. Okay, so this is the if else condition based upon which you have to start adjusting your trade. So my question was, when should we adjust delta neutral positions? Whenever the overall positional delta crosses 15 or minus 15, right at that point of time we should start making adjustments. Okay, so now let's move to 1 day ahead. Okay, so the next day we can see that the delta has dropped, so it's not at all a matter of concern. we can just sit idly and keep watching the markets. So right now on the next day we are in a profit of 62.5 rupees. Let's check on 17 on the third day. On the third day it's a matter of concern because the delta is gradually approaching 10. So we need to be a little bit of alert. We don't need to have a look at the charts or have a look at the news because they are going to affect our psychology while trading. They are going to make us impatient, so no need. Okay, in case if you cannot handle the patience after seeing to the charts, after watching the charts, then leave it. Don't no need to look at the charts, just have a look at this delta, just track this Greeks. Okay, so it was 17th of November and it's 9.45. So it's a matter of concern. Okay, it's a matter of concern that it is gradually moving towards 15. Okay, it is gradually approaching 10. So let's move to the next day. It was 18th of November, the opening bell of the market. It's 9:30 a.m. right now, and right now you're in a loss of 337 rupees. And the matter of concern is the positional delta. It has crossed 15. It's 16.89 right now. Okay, so let's just wait for 5 minutes and have patience to wait for the market to reverse the delta. But even after 5 minutes it has increased. It's 17.09 right now. Okay, don't no need to spend more than 5 to 10 minutes. Don't no need to keep patience after 5 to 10 minutes. It's just a checker that whether you finally need to adjust or not. So finally after 5 to 10 minutes we are seeing that the delta hasn't decreased, rather it increased, and it's 17.09 right now. So right now at this point of time we need to make adjustments. So what is the adjustment rule? Okay, first you have to check the payoff chart. Okay, so in the payoff chart we can see that when we had initiated the position, the price line was right at the center of this iron condor. Okay, right at the center of this iron condor. But gradually with the progression of time, as the market, as the underlying price moved to the downside, okay, this price line in this trade, it has also moved gradually to the left side. Okay, so which one is the untested side here? So this side is your untested side here. The price line hasn't touched this side. Yes, this one is a untested side here. Okay, so you have to keep on rolling over your untested side. You have to keep on booking profits from your untested side, and at the same time you have to replace those with newer call options, with newer call spreads, to adjust the delta, to make the strategy a delta neutral one again. Okay, so then how will we do that? How will we solve the both of the purposes? Okay, right now you can see that this 18,500 call short and this 18,700 call long, this duo is giving us a profit of around 1500 rupees. Here is a profit of 2200 and here is a profit of 700. So it's around a profit of 1500 rupees we are getting from this call spread. We need to book this right now. Okay, so we will book this 51.5 at 7.45 rupees. Okay, this one is right now at trading at 7.45 rupees. Okay, so we book this one, and this 18,700 call, this is now trading at 3.9. so we will book this at 3.9. okay, so we will book this at 3.9. okay, so see, we have booked 1500, we have realized 1500 rupees gain, and right now we have closed this call side. So we have to replace this call side in order to make this position a delta neutral one, because right now this is simply a credit spread. Okay, we have to make this a delta neutral position, we have to make this a non-directional position. So we have to replace this thing. Okay, because we have booked profit in this thing, we have to replace with some newer calls, with some newer call options, with some another call options. Okay, so how we need to do that? We need to match the delta. Okay, so what is the delta of the put option sold? Right now it is trading at a delta of 43.27. so we have to search for a call option which is trading nearly with a delta of 43.27. so let's search it from the option chain right now. Okay, so here in the option chain we can see that the 17,900 call, it is having around 45.44 delta, so we can short it, one lots. Okay, and in order to hedge it, okay, so what is the delta remaining? Okay, so the remaining delta is 26.05 after taking this position. So we have to search a call option of 26 delta and we will buy it to hedge this call position. Okay, so let's search call option of 26 delta. So it's 24.25, 18,100 call. Okay, so we will buy this one. Okay, which is nearly equal to 26. Okay, so right now have a look at the delta, it's only 4.54. We are now able to manage the delta, and we have realized some portion of our profits to be on the safer side as well. Okay, so this is the rule. Okay, you have to make the delta neutral. Okay, this way you have to make the delta neutral. So now let's have a look at the payoff chart. See, the payoff chart is drastically narrowed, the range is narrowed. Okay, but see one thing, that earlier the risk reward ratio was 1:5, whereas now it's 2:1. Now your max loss possibility is lesser than the max profit, okay, that you are going to get. Okay, now there is a skew in the risk reward ratio. Okay, this was the thing we were wanting to make, because whenever things are going wrong, the first thing that you have to protect is your risk reward ratio. So first thing you have to tune is your risk reward ratio. So by this method we are able to tune our risk reward ratio to some extent, and I'll show you more such methods. Okay, so right now what is my viewpoint, that the market should stay within this range for us to make us profitable. But let's move to the next day and see, even after such an adjustment, even after making it as much narrow as possible, it has tested one of the sides. So the last thing we can now do is we can move till 50 delta. Okay, we can move till 50 delta. Right now you can see there is again imbalance, there is again an imbalance in the delta here. Okay, again an imbalance. Right now you don't need to look at whether it is crossing 15 or not. Right now you just need to look that whether either of these sold options, their delta, either of their delta has crossed 50 or not. You can see that the one in the put side, its delta is right now trading at 65.14. It has crossed 50. Okay, so if either of them crosses 50, the last thing that we can do is we can convert it to an iron fly, which means we will book profits from this call side position. Okay, right now there is a net profit of 3940 minus 1825, which is around 2100 rupees. We will realize this profit and we will sell a call at the same strike price at which we have sold this put, that is at 17,800. Okay, so this is the last thing that we can do for the iron condor. Then we will speak about how to adjust the iron fly. Okay, so let's move to the PNL and let's book profits. So this one we have sold at 119.5. we will book at 40 rupees. Okay, so this one we will book at 40 rupees. Okay, so we have booked profits here at 40 rupees, and this one we have bought at 48.05, and we will book profits at 12.05. okay, at 12.05. okay, at 12.05. I'm so sorry. Okay, so I have modified this position as well. Okay, so we have realized 2100 rupees, and the last day we have realized 1800 rupees. So we have 3900 rupees realized in our hands. And right now you can see that the right now what are the, so right now what we have to do, the last adjustment is to sell a 17,800 call also. Okay, so let's move to the option chain. So let's move to the option chain, and okay, let's move to the option chain, and we have to sell a 17,800 call also. Okay, we have to sell a 17,800 call also. So what is the delta right now? It's a 10 delta. Okay, so there is a 10 delta, so we have to search for a 10 delta call. Okay, so this one is a 10 delta call, nearly equal to 10. Okay, 18,050. so I am buying this. Okay, and what I made is, now let's have a look at the payoff. So let's have a look at the delta first. It's 1.29. the overall delta is 1.29. and now let's have a look at the payoff chart. Right now I have converted my position from an iron condor to an iron fly, and just have a look at the same, my friends. The max profit is now 7,000 rupees, and whereas the max loss is 5,000 rupees, which means there is a continuous skew in the risk reward ratio. Earlier when we were in an iron condor position, the risk reward ratio was just the reverse, but right now it has reversed. Right now the probability of the trade, it may be low. Okay, but right now the reward involved is more than that of the risks. Okay, and right now you are in a net loss of 357 rupees, even after a 700 to 800 points move. Okay, in Nifty there is a 700 to 800 points move by far, and still now you are only in a loss of 357 rupees. Okay, in case if it was me, I could have exited my market, but I'll show you that even after this we can even after this we can keep patience, and even after this we can keep going on adjusting our positions. Okay, so right now our iron condor adjustments are done. Right now we are sitting with an iron fly, and even we can adjust this to increase our profit potentiality or to decrease our loss potentiality. So it's only 3 days prior to the expiry date. It's 22nd of November. So just let's move 30 minutes more. Okay, now we will move slowly. Now we will monitor our trade with more densely. We will monitor our trade more frequently, because there is a 700 or 800 points move in the market. So let's just move 30 minutes more, and you can see that even after placing an iron fly trade, even after that the market is again continuing its downward movement with the heavy momentum. Okay, so on this side the maximum loss that you are now going to get is only 2.5k rupees. Okay, earlier the loss was 7.5k rupees, whereas even if the market touches zero, even if the market falls until it reaches the ground, okay, until it slips to the ground, the maximum loss that you will make till expiry date is 2.5k only, which is 3 times that of that 7.5k loss without any adjustment. Okay, but there are traders, there are people with very aggressive mentality, okay, who will even try to minimize this as well. So what will they do? They will simply search for the untested side in this iron fly. So what is the untested side? See, this price line, it has touched this edge of the iron fly, but not this one. So this edge, this call edge, okay, this one, this side is the untested side of this iron fly. We have to just make another copy of this untested side, which means we have to sell another 17,800 call, and we have to buy another 18,000 call to hedge it. Okay, simply we have to make one more copy of this trade. Okay, we have to simply make one more copy of these two positions. Okay, so what are the positions? A 17,800 call has been sorted, a 18,050 call has been bought. Okay, so we will do the same. So let's move to the option chain right now. Okay, so here is the 17,800 call. We will short one more lots. Okay, we will short one more lots, and here is the 18,050 call, which we will buy one more lots. That is, we have made a copy of our untested position, of our untested side position. Okay, so this is the thing that we have done. Now look how the thing looks like. Okay, now let's hover the mouse on this thing. So here you can see that the max loss, even if the market touches zero on the expiry day, would be 610 rupees only, which is 10 times, more than 10 times than that of the loss that you could have faced in case if I won't have made any adjustment to the trade. Okay, so now the max loss, the max risk to the downside has been kept to 610 rupees only. And what can be the max profit from this trade in case if the market reverses and falls within this green territory? It's 9,247. Let's check what has happened. So let's move 30 minutes more. Okay, so let's move 30 minutes more. Let's wait, because we will try our best. We will not come out from the market till the expiry date. We will try our best. Okay, whenever the loss is lesser, whenever we will see something green, we will just pop out from the market. Okay, see, it was 22nd of November, 1:35 a.m. See, the price line is moving in the fixed loss region, but right now you are in a net loss of 160 rupees. Isn't it enough to save a position which could have made a loss of 7,200? You are facing a loss only of 160 rupees. Isn't it a lot? Okay, so this is all for this video, my friends. I wanted to share that how I saved myself from such a drastic move, even after being a direction neutral trader, even after being very range bound trader. How was I able to keep myself calm, and how I just kept on doing my work, how I just kept on following my discipline, and without any extra pressure, without any heavy burden, without any high blood pressure, or without any without any kind of anxious judgments, any kinds of anxious moves in the market. I am able to manage huge losses with negligible or with minimal amount of losses, okay, by tracking only the delta and the payoff here. Okay, by far, while I was explaining you this adjustments, neither for a single time I had a look at the charts. Okay, now let's have a look at the charts, and now look at the fall here. Okay, now look at the fall here. It is a fall of around 1,000 points. Okay, so this was the fall which we have handled, and that too we are exiting with a net loss of 160 rupees only, even after placing an iron condor strategy. Okay, so I hope I could have made you understand that why to adjust, when to adjust, and how to adjust. Okay, so if case if you have liked my little endeavor to share with you my thoughts, my horizons, then please do help me by liking this video. Please don't forget to subscribe my channel, and don't forget to hit the bell icon, that so that whenever I make any such interesting concepts, whenever I share any such of my traits, I'll be able to reach you on your notification tab. So we'll be watching you in the next video, friends. Stay tuned, and please share this video with people who are searching for directionless ideas, but still, due to this massive drawdowns, they are feeling that even direction neutral trading is not going to work. Okay, so it can happen that it can happen for some traders that some major drawdowns have made them feel like the grapes are sour, but story is not all that. Okay, so it's just a mind game, it's just a game of patience, and it's just a game of staying calm. So repeated number of times I was telling you that don't look at the charts, track only the Greeks, track only the probability. You just need the probability to win, you need nothing else. Okay, because if you just have if you just repeatedly look at this chart, this green and this red candles, this will make you aggressive, this can make you biased, this can erase your calmness. Okay, which is very much necessary to stay as a consistent derivatives trader. So this is all that I wanted to say. So see you in the next video, and on this topics, especially on this delta, on this Greeks, and on why am I selecting the 20 delta for selling, why am I selecting the 10 delta for hedging, what is hedging, about these things. In case if you are a beginner and you want to know in more detail, then there is a happy news for you, friends, that I am going to make detailed videos on each of those topics, and I am going to share them with you. Just don't forget to subscribe this channel and press the bell icon. Thanks for watching.